Hello everyone, and welcome back to the channel. Today we're diving into the fascinating world of options, with a special focus on put options. Whether you're new to the financial markets and want to understand the basics, or you're looking for a refresher, this video is designed to help you learn. By the end of this, you'll understand what put options are, how they work, and their role in the financial markets, with a deep dive into key concepts like volatility. So, grab a notebook, get comfortable, and let's get started. First things first. What is a put option? In simple terms, a put option is a financial contract that gives you the right, but not the obligation, to sell a specific stock or another asset at a predetermined price within a set period of time. That predetermined price is called the strike price, and the set period of time is known as the expiration date. Think of it like an insurance policy for a stock, allowing you to sell it at a guaranteed price, even if the market price falls, but only if you act before the option expires. So why might someone consider a put option instead of just selling a stock outright? Great question. Put options are a unique tool because they offer leverage, meaning you can control a large amount of stock for a relatively small cost compared to owning the stock itself. They also allow you to benefit from a stock's price decline without owning the stock or engaging in other financial transactions like short selling. Additionally, they can serve as a way to manage risk in a portfolio. Intrigued? Let's break it down step by step. To understand put options, let's look at their key components. Every put option has four main parts: the underlying asset, the strike price, the expiration date, and the premium. Let's go through each one. The underlying asset is the stock, index, or other financial instrument the option is based on. For example, if you buy a put option for Tesla stock, Tesla is the underlying asset. The strike price is the price at which you can sell the underlying asset if you choose to exercise the option. For instance, if you buy a put option with a strike price of $100, you have the right to sell the stock at $100 per share, no matter how low the stock's market price drops. The expiration date is the deadline for exercising the option. After this date, the option becomes worthless if you don't use it. Options can expire in days, weeks, months, or even years, depending on the contract. Finally, the premium is the price you pay to buy the put option. It's like the cost of that insurance policy we mentioned earlier. The premium is determined by factors like the stock's price, the strike price, the time until expiration, and market volatility. We'll dive deeper into these factors, especially volatility, in just a moment. Now, let's walk through a real-world example to make this crystal clear. Imagine you're looking at a company called Cloud Corp, which is currently trading at $100 per share. You've noticed some market signals suggesting Cloud Corp's stock might drop in the next month, perhaps due to a challenging earnings report. To illustrate how a put option works, let's say you buy a put option for Cloud Corp with a strike price of $95, expiring in 1 month, and the premium is $4 per share. Since one option contract typically represents 100 shares, you pay $400 for the premium. That's $4 times 100 shares. This is a small cost compared to other ways of engaging with the stock. Fast forward a month and Cloud Corp's stock has fallen to $80 per share. Your put option gives you the right to sell 100 shares at $95, even though the market price is now $80. If you own the shares and exercise the option, you'd sell them for $95 each, receiving $9,500 instead of the $8,000 you'd get at the market price. That's a $15 per share difference, or $1,500, minus the $400 premium you paid. That results in a $1,100 difference. But here's a key feature of put options. You don't need to own the stock to benefit. Many people who buy options don't exercise them. Instead, you could sell the put option itself, which has likely increased in value because the stock price dropped. For example, the option's premium might now be worth $12 per share, so you sell the contract for $1,200, resulting in an $800 difference after subtracting the $400 premium you paid. This flexibility is a big reason put options are an important part of the financial markets. Of course, there's a downside. If Cloud Corp's stock stays above $95 by the expiration date, your option expires worthless, and you lose the $400 premium. That's the risk with put options. Your loss is limited to the premium you paid, but you can lose it all if the stock doesn't drop below the strike price. Let's talk about the main purposes of put options in the financial markets. There are two primary roles: benefiting from price declines and hedging. Let's explore each one. First, benefiting from price declines. This is when someone buys a put option because they expect the stock price to fall. In our Cloud Corp example, the put option allows you to gain from the stock's decline without owning the stock or engaging in other transactions. Because options are less expensive than buying or selling stocks directly, they can amplify the financial impact of a price movement, but they also carry the risk of losing the premium if the stock doesn't drop. Second, hedging. This is where put options are often used as a form of insurance. If you own a stock and are concerned about a potential price drop, a put option can help limit your losses. For example, if you own Cloud Corp stock and worry about a market downturn, a put option ensures you can sell your shares at a fixed price, protecting you from a larger loss. This makes put options a valuable tool for managing risk in a portfolio. Now let's get into the factors that affect a put option's price, or premium. This can get a bit technical, but I'll keep it clear and focus on volatility, as it's a critical concept. First, there's the stock price relative to the strike price. If the stock is trading close to or below the strike price, the put option is more valuable because it's more likely to be profitable. This is called being in the money. If the stock is far above the strike price, the option is out of the money and typically less expensive. Second, time until expiration. Options lose value as they approach their expiration date, a concept called time decay. The more time left, the higher the premium, because there's more opportunity for the stock to drop in your favor. Third, volatility. This is a big one, and it's worth spending some time on because it's central to understanding options. Volatility refers to how much a stock's price tends to fluctuate. There are two types of volatility that matter for options: implied volatility and realized volatility. Let's break them down. Implied volatility reflects the market's expectation of a stock's future price fluctuations, as embedded in the option's premium. It represents the anticipated annualized price range expressed as a percentage, within which the stock price is expected to move with a 68% probability, one standard deviation, over a year. For example, if Cloud Corp has an implied volatility of 20%, and its current price is $100, the market expects the stock price to fluctuate between $80 and $120 over the next year, with a 68% likelihood based on current option pricing. This expectation is derived from the option's market price using models like the Black-Scholes formula. High implied volatility means the market anticipates larger price swings, increasing the chance that a put option could become in the money, so the premium is higher. For instance, if Cloud Corp is about to release earnings and traders expect significant price movement, implied volatility will rise, making put options more expensive. Implied volatility is dynamic. It often spikes before events like earnings or economic data releases and drops afterward when uncertainty decreases. Realized volatility, also called historical volatility, measures how much a stock's price has actually fluctuated in the past, typically over a period like 30 days. It's calculated by analyzing historical price data and determining the standard deviation of daily price changes annualized as a percentage. For example, if Cloud Corp's stock price has varied significantly over the past month, its realized volatility might be 30%, indicating substantial past price swings. Realized volatility is backward-looking and provides context for a stock's historical behavior. While it doesn't directly set the option's premium, it helps you compare implied volatility to past price movements. If implied volatility is much higher than realized volatility, it might suggest the market expects more turbulence ahead. If lower, it could indicate a calmer outlook. Understanding both helps you grasp why an option's premium is priced the way it is. For put options, higher implied volatility increases premiums because it raises the likelihood of a significant price drop, making the option more valuable. The interplay between implied and realized volatility is key. If implied volatility is high but realized volatility has been low, it might mean the market is overestimating future price swings, potentially making options pricier than justified. Conversely, if implied volatility is low but realized volatility is high, options might be relatively cheap. Understanding both helps you grasp why an option's premium is priced the way it is. For put options, higher implied volatility increases premiums because it raises the likelihood of a significant price drop, making the option more valuable. Finally, interest rates and dividends can also affect premiums, but they're less significant for most learners. Higher interest rates can slightly decrease put option premiums, while expected dividends can increase them. At this point, we're about 2/3 through the video, and I hope you're finding this informative. If you're enjoying the content, please take a quick second to hit that like button. It really helps the channel grow. And if you want more educational videos like this, don't forget to subscribe and click the notification bell so you never miss an update. Thanks for your support. Let's talk about some key concepts to understand when learning about put options. First, it's important to know the underlying asset, whether it's a stock, an index, or another instrument. Understanding what drives its price movements, such as company performance, market trends, or economic news, can provide context for how put options behave. Second, consider the importance of risk awareness. The premium you pay for a put option is the maximum amount you can lose, which makes options different from other financial instruments where losses can be larger. However, because options can expire worthless, it's critical to understand this risk up front. Third, pay attention to the expiration date. Short-term options are less expensive but require the stock to move quickly to be in the money. Longer-term options cost more but give the stock more time to move, affecting their value differently. Fourth, familiarize yourself with the Greeks. Metrics like delta, which shows how much an option's price changes with the stock price, and theta, which measures time decay, provide valuable insights into how options work. Most trading platforms display these metrics for educational purposes. Finally, consider exploring options through educational tools. Many platforms offer resources like paper trading accounts, where you can simulate buying and selling options without using real money. This can be a great way to learn how put options function in a risk-free environment. Now let's cover some common pitfalls to understand when studying put options. One major one is focusing only on options with very short expiration dates because they're cheaper. These options are less likely to become profitable unless the stock drops significantly and quickly. Another pitfall is overlooking the bid-ask spread, the difference between what buyers are willing to pay and what sellers are asking. A wide spread can affect the cost of entering and exiting a position, so it's worth understanding liquidity in options markets. Also, it's important to avoid making assumptions based on hype. Just because a stock is dropping or trending on social media doesn't mean a put option will automatically be valuable. Understanding the underlying reasons for price movements is key to grasping how options work. Phew, we've covered a lot today. Put options are a fascinating part of the financial markets, offering ways to benefit from price declines or manage risk through hedging. They come with unique characteristics, so education is essential. I hope this video has given you a clear understanding of what put options are, how they function, and the critical role volatility plays in their pricing. Before we go, I'd love to hear from you. In the comments below, tell me, what's something new you learned about put options or volatility today? Or what other financial topics would you like me to cover in future videos? Your feedback helps shape the channel, so drop your thoughts below. Thanks for watching, and if you found this video helpful, please give it a thumbs up, and subscribe for more educational content on finance and markets. Until next time, stay curious and keep learning. Thanks for watching, and if you found this video helpful, please give it a thumbs up and subscribe for more educational content on finance and markets. Until next time, stay curious and keep learning.